adopted, he received the Nobel Prize for it. So we say that it's the only, Nobel Prize in accounting, Richard, the 70s. But of course, so are standards, but not really implemented. And I mean, as IFRS would be very consistently. Some countries follow them, some countries follow part of them, some country follows an old version, some country follow a new version, and so there are a really wide set of standards. And from the database as well, we have various databases. You can go to the countries of course, the country's reports, financial reports, or you can go somewhere at the government level, government accounting, or you can go at a national accounting level where international institutions and statisticians work on it. But for example, the IMF would have two different standards, sets of data, the World Economic Outlook or the Governance Finance Statistics. And when you look at the debt data, they would disagree. They would not have the same general governmental debt level from the YO and the GIFS because there are many different instruments you can take, valuation you can take. And the World Bank has also its own one. So of course, this creates kind of a complex area to work on. And so the IMF has been working on it. Mainly the IMF they have been working, and we've been discussing with the IMF very frequently as well in the past and recently. But they chose one topic as for their annual legal conference last year, and it was really the legal foundation of public debt transparency. So the conference is in fact can be seen online. It has been recorded, so it's an open debate. But the event really addressed the pressing issue of data opaqueness and highlighting the rule of law, of course, and enabling the debt transparency. So that's an important question as well for policymakers and international institutions. And so Kristalina Georgieva from the IMF, managing director, said while she opened that conference that too much debt remained hidden and that this had been increased in the recent years, especially due to the complexity of debt instruments that would be at play. It wouldn't necessarily, for example, the central bank that would be issuing debt, but more a state-owned enterprise or public-private partnership that would be almost like the government, but not consolidated. So and I'm a statistician that really helps us a lot. Really, that debt reporting is still the Wild West. It's unregulated, inconsistent, and often opaque. So it's very different from, for example, the figure of the GDP, even though it's very important. The CRAs, they have to issue comparable ratings. And in order to issue comparable ratings, they need to have comparable data. So they have to deal with this inconsistency. It's part of their job. And they struggle. Moody's says it's one of the most complex areas. Coverage, definition, measurement, Fitch says it's difficult to prevent discrepancies. And S&P says, it has nothing to do with the audited annual statement of a corporate entity. So, a lot of it is just estimates. And so it's hard to agree on what the general governmental debt level of a country is. So that's what we studied. And I saw that because when I worked as a rating advisor, we challenged some of the CRAs on the debt level they considered for a specific country, in fact, for the US. And we saw and saying, questioning whether it was comparable to the measurement of European countries. And we saw that one CRA really decided to change the measurement of the United States debt, by adding it 6 points of GDP in it. So there is a lot of um, of choices done by the CRAs in order to come to decide on the debt level they would consider in the rating. And so we think this is a bit of an unknown area. So we're shedding some light on this topic. And as Shiva likes to say, there isn't much research yet. There are about more than half of the economy. However, accounting research is mostly focused on corporates, and there's very relatively few done in sovereign. So he states baby steps are arguably okay. We don't know much, so we shed some light on it, on what, would be the drivers and this implication of this debt assessment dispersion. So what can we do to understand better why countries disagree, why CRAs disagree on debt levels, and what are the implications of those disagreements? So we will study four different drivers: the accounting, the economic, the governance, and or institutional and political ones. And the applications would be naturally ones like ratings and yields. So from the driver's perspective, we will focus really on the supranational debt rules, and these seem to be very, 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 very important. They can be, national, supranational or national debt rules, and they can be enforced or unenforced. There is a very nice data set, some on debt rules worldwide. So we use that one. And then also the type of political system, so either being presidential or parliamentary. In the political science literature, we do know that the presidential um, systems have much more concentrated power in a few hands. So there might be more possibility, of just putting the debts elsewhere than in the most central government level or, local authorities. And how autocratic or democratic the country is, and also some economic and in elements like inflation, debt, and interest. And from the accounting side, we study contingent liabilities. So we have two kind of measure, either it being in the financial contingent liability, so more related to the banking sector. We know, in fact, that 1 out of 4 defaults, sovereign defaults, would be related to the banking sector. When they have to rescue a big bank, and then the countries it's just too much for the country. So that there is a default. So we those financial contingent liability are very important from a rating perspective, and we try to see if the more there is financial contingent liability, then this potentially leads to this dispersion in the measure, because some CRAs might consider it as general governmental debt. When you help too much of a bank, it's almost like a public bank. So, and then there is the non-financial one, which would be the state-owned enterprise, the public-private partnership. So we have a measure there from Fitch. So it's not perfect, but it's what the best we have. Yeah, and we do see that there is a positive effect of the contingent liability here. And the implication, we will study the ratings disagreements. If you have more dispersion on the debt assessment, do you have more dispersion than the rating? We do find that. And also, if you have a bigger probability, if you have a high dispersion, is your probability of having a downgrade higher? Yes, it is, in the next 4 quarters. And also, but you have then less probability of an upgrade. So we do see that. And then also, we compare that to the yields levels, and we do see an impact. So this is how our dispersion index looks like. So we have, over 81 countries which have a relatively low, a low dispersion, so quite an agreement. So, what is interesting about this index, it's not something that would be developed or developing economy at all. It's really something, we have a high developed economy like Canada or US who have a relatively high or medium dispersion, whereas so that's an interesting finding by itself. Um, so the European Union would have a very low dispersion, and we explain that, and it comes up in the data as the existing of a supranational end force that rule. And then, so so the other countries with medium would be, Canada and the US would have a medium disagreement among 2.3 and, or more 7 or, point of GDP. So relatively high. And a few countries, 5 or so, have very high disagreement, like Argentina, China, in fact, Japan, Hong Kong as well. So we are digging into some of those examples. But what we have done as well is find out why it creates those disagreements. So we have done that for Germany and the US, and we're working on with Hong Kong and probably an African economy as well. So as we say here, the European Union has the lowest disagreement of the lowest mean with 148 a percentage of GDP of dispersion, and East Asia and Pacific would have the highest with 4.7, but I check and Indonesia has a 1.47, so it's rather low. Um, you know, um, but overall in the region, it will be high. And please feel free to interrupt me if you have any questions or so. That's totally possible. And so this is the same measure, but just by US billion. So of course, there we know that the US, or US and Canada, I mean, just the size of the country in North America are huge. So this is why the mean would be much higher in terms of dollar number, 330 in billions disagreement for North America. And, the second afterwards would be East Asia and Pacific. And over time, so in blue is the line with the percentage of GDP, and in in orange is the ones on by US billions. So if we look at the blue line, we do see that there is a greater dispersion during the financial crisis and around 2008 to 10. And then there's also a gradual increase from 2015, which we think is related, as the IMF said, about a more complexity and an increased number in contingent liability. I mean, we see this in the data. And the line in orange here just shows an increasing value of in the disagreement in dollar number. So this is as the debt keeps increasing, then of course the dispersion in dollar amount keeps increasing as well. So the sample here is so worldwide, we have to have two countries at least rated. So that's rated by at least two countries. Quarterly data, and we have 13 years, so 2006 to 2018. Our data set stops in 2018 because Moody's unfortunately stopped releasing those data on the file we use in 2019, and we use the to evaluate the 2018, we used the publication of 2019, so we had to stop then. And the main variable is the standard deviation of the general governmental debt in percentage of GDP. And the three CRAs would be the major one, like Fitch, Moody's, and S&P. So here I will just spend, a few minutes on presenting some examples So, as I said, we focused on two countries for the moment. So Germany and the US. So and we look at the debt 2018 published in 2019. So these are no forecasts. These would be historical data. So, in theory, there is relatively few estimation here from a normal perspective of accounts. And here we see there is a large agreement. They say, this is 61% of GDP, that's 61.9, 60%. So the very low disagreement, 0.96. And then CRAs also report the GDP in dollar amount. So then we can compute the debt in dollar amount and then the dispersion in dollar amount. So it's about 36.7 billions for Germany. And we tried to understand, okay, what is this 37? So, or where do they take their number from? Because the limit of our data is that we don't know the adjustments that CRAs really do. This is really, confidential. They do not disclose, CRAs do not disclose the adjustments they do in order to arrive to a general governmental debt level. They do so for corporates. This is very clear, but unfortunately, they don't publish and we discussed with CRAs, and they don't publish the adjustments they do. So low disagreement for Germany and, medium one in 2018 for the US, because one CRAs would say it's 89% of GDP, and the other one, Fitch, the highest would be it's 98%. So it's quite a high, a medium in our sample. It would be medium. It's about our medium value, 4.5 percent of GDP of this agreement, but this is, high debt numbers, so this would be 928 billion of this agreement. So, yes, so up. Yeah, I did have I wanted to, yes, so we will come back to those examples later on. But what is, related to those two examples and what we will see in the data is that rules matter a lot, so either being it national or supranational or both. So we see, and this is, EU has a lot of debt rules, to limit the growth of the debt rules that have, been lasting for a few decades or now less in place. But since they decided to remove a bit those, yeah, remove the debt rule in order to increase the defense spending. But there are also rules, in Africa, in Asia, and in Pacific region as well. So it's and there are, however, very few rules in North America and South America. So, and these tend to matter a lot in terms of drivers for debt agreement, because here we do see here from an institution perspective, yes, the debt dispersion. So we are as much interested in the debt dispersion antecedents, drivers, than on the implications of it. And so for the drivers, the national debt rule and the supranational debt rules seem to matter a lot. And we see that, it's really first the national has an effect, and then a slightly bigger effect is the supranational unenforced one. And then this would be the enforced one having the largest effect. From a political perspective, we see that there is more disagreement when it comes to a presidential system. So when the power is being very concentrated. And there is a correlation between the presidential system and autocratic system, which are, close to being significant as well. So in terms of debt, we do see that when there is, level of uncertainty or so high degrees of debt or high degrees of inflation, then the dispersion really increases here. But it's not related so much to the interest or the GDP or GDP growth or rating level. So this is interesting. This is what we, have seen graphically. The dispersion is not really related to ratings. It's not, the US has a very high rating, but still a medium level of dispersion. So this is across country. However, we will see that within a country, this matters a lot. That the rating level, is associated, rating changes are associated to the dispersion level within a country. So in terms of accounting, we checked for the GDP assessment dispersion because we really wanted to assess, the debt dispersion and not so much the denominator on the GDP, even though we know there's much less dispersion here. And also the variation in the SFA. This is an accounting measure and the difference between the growth in debt versus the deficit. For some in the political science literature, um, there are a few papers discussing the effect of this stock flow adjustments, meaning that some country kind of do not report an increase in the deficit, but have it directly as an increase in debt, and that this is, partially, um, partially perhaps data, improvement, data nudging, or data. So managing a little bit, your earnings as a country. And so we control for that in all of our regressions. And also, so this is the significance of the contingent liability. So we have this data from S&P and Fitch, and we do see that, the biggest impact is on the financial contingent liability. Here we do see so that it does drive the dispersion. So and we will see that in our examples, some CRAs do tend to include some of the contingent liability back into the debt when they consider that this, there's a level of certainty that the contingent liability will be paid by the government, and so they added back. So yeah, so back to our example, see where Germany with the low disagreement and US, and we will see the impact, I think, on, for example, for Germany, the impact of having a debt rule. Well, debt rules, come up with clear enforcement in the European Union, and Eurostat will publish all of the EU's will publish all of the EU's financial numbers in terms of GDP, deficit, and debt. So here for the year 2018, they do say, this is 2 trillions in terms of euros. And afterwards, what CRAs need to do, so we try to reconcile, they will use this exchange rate or another one. And here we do see, there's very, very little difference, 4 billion or 65 billion. So they really do take into account the number from Eurostat, and then they just use it for their ratings. So this is kind of an easy example to reconcile. And when we talk to the CRAs, it does match it. It does coincide with what they say. However, from the US, it's a very much complicated story. We have different sources, and they don't really disclose what they do, except Moody's describes a bit more just in one sentence that it's debt held by the public and credit market instruments of state and local. So that helped us. And a person from the IMF statistical department helped us as well to a bit try to, at least understand or, validate that what we thought they would do wasn't completely unrealistic. But so the debt disagreement would be here 4.51. And so what Fitch would do, we think, they would take just the debt securities from the central government, from the general government. So, and then the loans. So this is, from the government financial statistics from the IMF. And so Moody's, what we think they do is there is another source, which is the central government, published by the US Treasury. So it's called Debt by the Penny. It's a website. And we think they take this number, because they say they take the public, and then the credit market instrument of state and locals, and then probably a little bit of contingent liability here from the financial insurance and guarantee program. So this would be, our assumptions. And we see that, that's, for example, they would take that number here, that number from the debts held by the public, that number here from a state and local government, only the securities entreprise. So one number from the general government, central government, one other number from the state government, and then a little bit of more of guarantee that they might be looking into the financial statement. So that we say they would be taking their insurance and guarantee program here. So they kind of mix match the sources. This is what they say as well. That they mix match the source, and they come up with with their own estimates of the historical numbers of the general governmental debt level. For S&P, we think that they only take the debt securities from the general government, so they would take, 18 trillions here, 18 trillions from here, 18 trillions. So this is our reconciliation of what they take for two countries. We aim to do that for a few countries, but this is just to show you how complex that is. And even when you look at the financial balance sheet, like a lot of, just as for corporates, a lot of the contingency and commitments would be also, off balance sheet, and they would be a lot of notes, and it would be, either something related to, to insurance and deposit, or here, or government-sponsored enterprise. As we say, some CRAs for some countries add them back in. So here that would be 250 billion. We don't think they include that for the US. But as Shiva says, the granddaddy of the debt is really the pension schemes. So anything that would be related to social security. Here, when they talk about sustainability, it's a financial sustainability. And this means, in fact, the future pensions, for the federal employees, but also for the federal employees, and also the social insurance, promises that they have for their own citizens. So that's, very different scale, because this is like 53 trillion and 46 when you just compare at what is on the balance sheet would be like 25 trillion, and what some CRAs considered as debt, that would be more closer to 20. So here it's like 54, compares to about 20% of GDP. So here we are in a way just scratching the surface in terms of potential future contingent liability that the CRAs would add back in. And no CRAs for any country would add the pensions of their employees in their balance sheet. So the Canada and New Zealand, they add them in, but then they would be removed from the CRA's general governmental debt in order to arrive somehow to a comparable number with the other countries. So what is, the implication of this debt assessment dispersion? So the first thing we look at is, does it have an impact in terms of debt assessment dispersion? That can be called also like rating split or rating disagreements. So this is just measured as the standard deviation of ratings. And so we do see that when there is more debt assessment dispersion, then there is more dispersion on ratings. And we control for a lot of things, like, well, country fixed effect firstly, but also debt and GDP assessment dispersion and GDP growth. So there is an effect on those assessment, that difference in debt assessment. And it makes sense because that is a major component in the rating analysis. So it's important to, I think, know that it exists and, hopefully in the future try to decrease the debt dispersion and improve debt transparency. So this is the full table with the controls. And we here also after look at the probability of are there any questions? Do you have any questions? I might just pause
Yes,
to
I
know
have a
if
questions.
Oh,
Excuse
yes.
me. Good afternoon. I'm from Timor-Leste. My name is Pascual da Costa Oliveira. I'm Airlangga University students. This month I will be attend my graduations. This is very helpful. Thank you for Prof. La Ode, my examiners. I'm very grateful as a contribution for my study. I talk about my dissertation is about budget transparency. This is we adopt from the Canada. Yeah, from free balance. And then my master degree also about the audit, internal control and external audit. And then few months, about 6 months, I applied the knowledge in Timor-Leste, and I used to cut all public institutions 14, and then public company 14, or total 24. Because they open too big, but very costly and then no benefit. I use a CBA, cost benefit analysis, and then I find out that this is wasted, and then I do this. And then the other side, I also doing my CPR, but not certified public accounting in Australia, but certified public passport in Timor-Leste, because I have my own originality to do this. And then this luckily, and then 2 weeks ago, we opened one bank about with a total money, very small, 55 millions, to open a bank, nossa banco, a nossa futuro. Our bank, our future. Bank kita, masa depan kita is utility. And then from UN side, from UN agencies and international agencies, they asked me to help this and that, and a little bit. Let me think, because I would like to apply my knowledge that I got from UNAIR university or college or professor. And then the main purpose is to be effective and efficient and then good in place, because many international staff here, they are too wasted, and then money that come only in the paper but not in the real case, in the reality. This is very helpful for me, but I still have problems with MSME, how to contribute for micro, small, medium enterprise. I'm doing this, but I will discuss with my prof in the Airlangga University, and then we also conduct with the Ikatan Akuntansi Indonesia, and then to do this to help me for the future. And then I just want to say that thank you, because this is not directly connect with Timor-Leste, but Timor-Leste is fragile country, small island country, and LDC, less developed countries. But this is very helpful for me. Thank you. Terima kasih.
Yes, so the one thing that we are thinking about, because it's slightly related, I think, to you, it's we are thinking about, checking whether if you have a grant from the IMF or to improve your finances, then does that decreases to improve, does that decreases our debt at dispersion index? So, perhaps Timor-Leste would be within our sample for that test later on.
Marion, before you carry on, I'm wondering, do you think natural resources endowment would have an effect on the debt assess dispersion, do you think? Because I believe some countries, they have more resource endowment, some countries they know. What do you think about that?
Yes, yes. So what we look at in this paper is really the gross general governmental debt because it's the most common used measure. So I think I mean not financial, but natural resources assets would be more kind of in a net, or even though when they net, they mostly net only the financial assets. So I think this the assets part would be more valued within if we were considering the net general governmental debt. But now the most CRAs they start with the gross number, and S&P, for example, does calculate and uses in the ratings also the net amount. But I think the net would be more financial assets because in the in the sovereign space, a lot of countries don't even have an asset repository.
Yeah.
So it's still very I think they exclude that. So the IMF has this balance sheet project for I think 24 economies where they do see that, assets where they try to measure, natural resources, assets and endowments. So they and then come up with a net measure that would be even more netted than just the financial assets. But it's still very, very new. I think it's not really expandable, so that's why CRAs they don't consider that.
All right. Okay. Thank you.
Mm, mm. But yeah, when you think about it's very rich in natural resources, then it's not really impacting so much the ratings as it as probably it should. But yeah, I will check because I have seen that there were also some other comments, but for some reason I don't see. Oh, okay, okay. I was seeing the chat.
Not yet. I think it's more about the
Ah,
oh, it's just the
perfect.
just the
Okay,
present.
okay,
Yeah.
perfect. Okay, perfect. Okay, so that then I could go back to the slides, screen sharing. Yes. Yes, here. Yeah. So it jumped, but I'm not at all in the contribution section. So here, what think we were so keen on looking as well was if it had an impact on ratings upgrades or downgrades. This is, what triggers sovereign yields, partly. So if it had, a real impact. And so we checked if it had an upgrade in the 4 next quarters or a downgrade in the 4 next quarters. And we did see that when there was an increase in a decrease in dispersion, then we were more likely to see an upgrade. So for example, if the CRAs, decided to agree that one contingent liability, for example, would not be excluded, would be then this had a positive impact on the probability of upgrade. And then on the really similarly for downgrades, when there is a debt assessment dispersion, even when you control for country, quarter year fixed effect, and also like debt and inflation and interest and a lot of controls, then you see that there is a downgrade. So we can really see how the full we see that when there is a variation in GDP, this matters in terms of debt upgrades. Of course, when your GDP really increases, then you're more likely to have an upgrade. When your GDP decreases, you're more likely to have a downgrade. And here, when your debts, when your debt decreases, you're more likely to have an upgrade. So it's in the same direction as the debt assessment dispersion. When your debt increases, and you're more likely to get a downgrade. So there are, a few points like that where the logic is there. And so the debt level matters, but also how CRAs disagree on the debt levels. And this is really an accounting question that is still a little bit unknown to many for the moment. So the last I think table we have for the moment is looking at the dispersion of debt assessment and the yields in the next quarter, and in the next year. Sorry, this is the next quarter. Yes, of course. This is the next quarter. I mean, it does hold for the next year as well, but this is in the next quarter. So we do see that when there is, this is related to when there is a higher also dispersion, then you see the yields of a country is really increasing. And then this in the controls, we see that what happens as well is that the debt assessment dispersion, when they disagree on the debt, on the GDP, then this is also has an increase in the yields. And also, of course, when you have a high period of interest, you're already raising your capital. I mean, it is very correlated, but it does make sense when there is a high notion of interest, then you have high yields and in the next quarter as well. So this would be the thing we worked on. So I think the literature, there is very little literature on sovereign accounting. So we kind of almost have to stretch ourselves to find something related. But we think that everything related to IFRS adoption, even though it is the corporate sector, it's somehow related to international accounting area. So we match to that literature, or we also match to a little bit of the one paper on this impact of sovereign fiscal reporting being audited or not, and the question of oversight due to the importance of debt rules. And the other literature we link it to, it's not written here, is the ESG disagreement, because of course now there's been this booming literature on how ESG ratings disagree. So and related to the disclosure of companies themselves. So even though here it's more it's more sovereign, it's financial reporting, it's still related to a disagreement in ratings, and here financial ratings and not ESG ratings. But most importantly, I think we shed on light also on the importance and the negative consequences of corporate off-balance sheet in accounting. And we shed light that, countries cannot hide forever their debts. So there is a cost because some CRAs will pick them up, some CRAs won't. But this will, be correlated with a higher level of yields. So as the managing director from the IMF said, she really advised country to clean up their books, because it can hit you even harder when the IMF finds it out than when you voluntarily do it, as it has been seen, for example, for the case of Greece in Europe, which created a huge sovereign crisis around the continent. So the debt rules matter a lot. We are currently working on improving this. Not improving, but seeing if working on whether there is an introduction of a debt rule, we really see the debt dispersion decreasing. So there is an impact of the currency unions, especially there are some in North Africa and also in the Caribbean. When there is a supranational currency union, then there is often a debt rule attached, and then they seem to have very positive impact on the debt dispersion index. So and contingent liability, yes, they do get partly captured by CRAs, So that's and then valued in terms of yield and probability of upgrade and downgrade. So accounting has really to play a pivotal role in tackling one of today's biggest challenge, the rise of sovereign debt levels. And we hope, I think, both Shiva, Jenny, and me, we really hope to inspire more accounting academics to study sovereign accounting. So there is kind of an area in more the qualitative area. So there are a few, notably academics, researching on the comparativeness of international governmental accounting research. There's a network named CIGAR Network that does mostly qualitative studies, and I started, working on qualitative studies too. But I think we do need some more empirical studies as well and there is, yeah, there are interesting recent interest, by journalists as well. So we hope that the field will emerge in the future. So I really thank you for your attention around this paper. If you have any question, please do. And if no, I can speak more about the project on the European Union by itself.
Okay. All right, everyone. I know you've got. I believe many things that you might ask to Marion. So yeah, you can simply type your question or raise your hand. No, but okay. While waiting for the participants, I'm wondering, Marion. You say that debt rule matters. You say that, right? Is there perhaps a particular threshold? Did you test that, for example?
Yes, yeah. So what we test was really on the drivers, on here the drivers being really up, in terms of, if you look at the coefficient, it's really it's mostly institutional that matters for debt assessment, and the debt rules really seem to matter, both national ones and supranational ones. And the enforced are really the ones that work the best. I mean, in terms of decreasing the debt assessment dispersion, and the unenforced work as well, and the debt national rule also works. So so the debt rule really have an impact. So it's also, perhaps the paper could also be seen as a call to introduce debt rules in countries that will help then the accounting quality. We don't name it transparency, we don't name it quality, because it's a bit more complex than that, but there is still correlation with those. So we really, advocate for the paper. We don't, but the paper really signals the positive aspect of that rules implementation. And the test I mentioned that we will work on is the new implementation of that rules in some specific countries. And so have a clean test on countries pre-adoption of that rule, post-adoption of that rule, and then seeing how the debt assessment dispersion decreases. So that's because we have seen that that rule is so important, then now we are doing another test on specifically the effect of that rule.
Yeah. Because in Indonesia we do have that rule. So the government debt should not exceed 30% of the GDP. Yeah.
And yeah, I saw that. So when I checked, I did see that Indonesia did have. So that's a very good point. It's perhaps what explains also, that the debt aspersion, it would be a mean of 1.40, and in the region it's much, much higher. So I think it does help to, at least does help to CRAs in terms of finding out what the debt number is, because then there is already highlight on what's the general government at that level. It doesn't resolve all of the problem and all the corruption that might be, unrelated, but it does help. It does help.
Yeah, but one thing that is being debated is about the threshold, because the government, when they set the public debt not exceed 30%, it's sometimes the government is finding it difficult to justify why that threshold. Yeah. So I'm just
Yes.
wondering whether there's possibly there could be a research to test whether a particular threshold might have, let's say, it's like has diminishing impact. I mean, maybe at some point, at first, that rule might help to reduce the dispersion, but maybe up to a certain point, it might not. I'm just wondering whether it's possible to do that.
Hmm. Yes, no, yeah. So it could be there, and then of course there's the accounting side and also the economic side. I think what is the most concerning is when, a threshold might in fact more impair some might think that the threshold might impair countries' growth. So that's another part. I do know that for the European Union, the threshold is more at 60% of GDP, used to be at 60. And now with the increase they want to do in terms of defense spending, it hasn't been um it's been just neglected. And and of course with a few countries like France being, close to 100, you question how much of a threshold it is. But I think to enter the EU, what we have seen is countries really needed to be beyond, below the threshold. And that also, so there is a paper saying that some EU countries played around the numbers in order to have the threshold, which is, expectable. But I think overall, like the French system, like put their debt in their railway system, like kind of and hid their debt there in order to enter the EU, and then it was added back in the debt a few years later. But it doesn't mean that it's not useful at all, even if it doesn't work perfectly. That would be our take on it. But we are indeed working on having a clear test on also the impact of enforcement. It's something to have an unenforced debt rule, but when there's a clear enforcement mechanism, then that can help as well.
Okay, all right. I think we have a question on the chat. I think this is from the questions from me. She's asking, I think the about the core concept of sovereign accounting. How would you define that? That.
How do we define sovereign accounting? Yes.
Yeah.
So yeah. So it's countries that would. So indeed, it is a term that Jenny, Shiva, and I coined. So it's not like very used. I think
Yeah.
the terminology that is the mostly used is the public sector accounting. That is very used. Public sector accounting. This means accounting for countries. And it would be countries, like no public sector. So it would be either the central government or the local government. And so in terms of sovereign accounting, we include everything that has to do with governmental accounting, which is everything that is related to the financial statements of companies, of countries. But you have to know that only about 15 countries only report financial statements. Most of the countries don't report financial statements. There is no balance sheet provided by many countries. So the accounting is still a bit, lacking. But so there is another layer that is more used. It's named the national accounting, and this work would be done by statisticians. So people, in the statistical office within a country, and then they would report to the IMF, to the OECD. So this would be national accounting. So sovereign accounting, there are two layers. There is the governmental accounting layer, done by accountants, and then there is the national accounting layer at a macro level, done by statisticians. But it's a very good question, and in fact, I shouldn't take that for granted, and I will add a slide on because it's not a very used term.
Yeah, I think yeah, we do have another question as well. He's asking about the core concept of software and accounting. Uh, I mean, probably if you want to talk more about software and accounting, this is I believe this is a I mean, this is a very relevant topic and very important topic, but maybe many of us are not familiar with the term. So
Yeah.
perhaps, yeah, perhaps you could explain more to all of us, to all the audience,
Yes.
the core concept of software and accounting.
Yes, yes. So it does. So in fact, something that can help as well is this. So in the terms when you talk about sovereign, we
Mm,
often talk about general government,
mm,
and general of government would be the central government, the social security funds of a country, and then the state government, so the local and state governments. And this addition would create the general government. And the general government is kind of more related to, I mean, to a country level, but country level with, that would include also like hospitals and universities and local municipalities and central government. And of course, in each country, the institutional context is very different. But when we talk about sovereign accounting, we talk about country level general government. So this is kind of a more widely used terminology. And then there are lots of different type of debts and liabilities here that countries can issue. So this is the classification of the IMF themselves. But most of it is when they take is mostly the debt securities would be the most source of debt issuance by countries. And then some countries would issue loans as well, and then some guarantees for pensions and so on. But this is related to the special drawing rights. So when the country finances the IMF, this creates a debt. So that's towards the IMF. So there are a few elements, but it's really when we talk about sovereign accounting, it means in our head general governmental, so kind of a wide area of what is present in terms of public sector in a country. But when at the first we used public sector accounting, and people really didn't understood it, or it wasn't very clear what it meant for some people. So, and the term governmental accounting is already used in the accounting literature by researchers that study US states and US municipality. They say that this is governmental accounting research. So that's why we kind of coined the term sovereign accounting research, which, is a mix of those national, it's a mix of the of what is done by accounting and by statistician. And it is very relevant for the CRAs because the CRAs, they mix both sources. Sometimes they use elements from the ministries. This would be ministries, so this would be done by accounting, the Ministry of Finance, and this is done by statistician. This is the IMF Statistics Department, and the CRAs, they use both, and this is they say that they say they use both, but they don't say exactly what they do. Yeah, yeah. I hope it clarifies a little bit, but indeed, it's not that there's not that many research on it.
yeah. Okay. All right. Any more question on the chat? Or perhaps anyone can you can raise your hand, can ask any question related to the uh, topic. Another I think another question. I think in your paper, Marion, you use historical depth values. I believe. Yeah.
Yes.
Do you think I mean, I'm just wondering what would be the reason why you chose the historical instead of the future debt values.
Yes, no, that's a very relevant question. So I think we changed that at the beginning. I mean, we made sure it was historical. In a previous version, we used nowcast, and the results are absolutely similar. We used 2018 data published in 2018, but we now are studying 2018 data published in 2019, so a year after. And what you are referring to in terms of forecast would be if we looked at 2000 publications of 2019 looking at the year 2020. And that part we didn't know, we didn't want, because we didn't want to include forecasts that would include much more estimates and much more assumptions from the country's future growth or future debt increase. So financing. So we wanted that to be kind of a backward looking element. So what we have shown in another paper I'm working on with Renning Petaki and Joe Weber, so from Georgetown University and MIT. So we are there looking at the forecast numbers, and here we do see that they are biased when the countries has, I mean, when the countries basically pays for the ratings, they have solicited ratings for their domestic currency ratings, then we see that the forecasts compared to the other CRAs are more optimistic when you pay for them. So that's where we use forecast. But here we absolutely didn't want to use forecast. We wanted to use historical data in order to avoid any this sort of assumptions from the CRAs on future economy. It's already enough to have the assumptions on what should the past debt be. Mm. Mm.
I'm not sure whether there's another question.
I could also present some of the previous paper, the first paper we worked on, if there is an interest on that one.
Oh yeah, I think that's okay. We still have
That's
time.
okay.
Yeah, 15 minutes time. Yeah.
15 minutes? Okay. Yeah, I can shortly present it, but I didn't. So yeah, so that's
Do you mean the 20th the paper published in Management Science?
yes, indeed, yes. Yeah, I had that.
I've shared that with the audience. They probably read
Okay,
the paper,
perfect.
I believe. Yeah.
Yeah, yes, perfect. So I can yes, hop talk about it. I was yeah. So here it's a much cleaner setting. So what we study here is really the AU. So it's a very different and we do know that accounting quality is very important for corporate debt contracting and for local government debt, but we don't know much from a sovereign perspective. So there are only a few countries, would default several times, but there are not that many. There are also different like incentives for manipulations than for corporates. So we didn't know whether or not there would be an impact on the quality of sovereigns, because a lot of sovereign debt is also bought, by a bank domestically. So there are also different incentives to buy debt than in the pure corporate sector. So what we looked here is it's a little bit the same structure as the paper I just presented, but it was what were the determinants in terms of economic indicator governance and debt ownership, and then the consequences in terms of rating, yields, and debt ownership. So what were the characteristics? We did say that the reservations were higher for deficit and debt country when you had lower GDP, and high level of SFA, stock flow adjustments, and that there would, be an increase in level of ownership by domestic central bank. And that interestingly here, the CRAs did not look at the reservations. It didn't seem to matter for them. So, but however, investors, it seemed to matter for them. So, when we talk to the CRAs, the CRAs, they would not have the reservation as an accounting in their accounting grids. They would maybe take it indirectly, but we don't see the impact on the rating there. So, what are the reservations that we're studying here? They are concerns about the national accounting numbers expressed by Eurostat. And Eurostat is the statistical arm of the European Commission, and they would monitor and they would assess the country's accounting quality, and they express reservations. So this is, a very high level of accounting quality in the world. It's perhaps there is no other entity with that power doing that in any other part of the world. So they would express a reservation. It's almost like a court of audits, but at a supranational level, which doesn't exist elsewhere. And it has doubt on the quality of the fiscal data being reported, or it maintains them, or it withdraws them. So we hand collected the reservations, and the reservations are issued when there is when countries do not follow the European system of accounts. So there is also clear same national accounting standards in the European Union. And this is what I was mentioning, like that it was like the governmental accounting was done as a micro level, and that the national accounting was done at a macro level. And these would be the governmental accounting, it's for financial reports. And here the national accounting, it's more the statistical reporting. And here the governmental accounting is mostly on cash. The accounting basis of national accounting is mostly accrual. And so this, the work we've been working on with the European Union is at a national accounting level. And this would be the one example, for example, on Greece. They would say they are expressing a reservation on social security funds. So the classification of some public entities and the recording of off-market swap. And so this would be an increase, in terms of 0.3 to 0.5% of GDP for the deficit and 5 to 7 for the debt GDP. So this is the reservation that really triggered the European sovereign crisis. So this is, had a huge impact on not only Greece, but also, Spain, Portugal, Italy, so a lot of countries. And then France also had a reservation on the Agence Française de Développement, and then they would precise, that it would impact here the deficit and not necessarily the debt. So here are the reservation. There are 67 reservations, and some were expressed, some were maintained, so some were concerning the deficit, the debt. We did see that the more impact on the deficit was the strongest effect. Some were quantified, non-quantified. I mean, I would not necessarily go on, but there is a variety. And they would mainly consider public corporation or another public sector entity or bank capital injection, so those would be the category. So Greece had a lot of reservation, 11. The UK, yes, a lot as well, but it was always the same reservation. And in fact, when we talked to the Eurostat person, they were saying, yeah, they almost didn't care. So I think UK always had a special relationship with the EU. They didn't often when they receive a reservations, countries, they change very quickly their accounts in order to not have any more reservations. But the UK, it was one maintained reservation over time. And France also had, 5, Portugal 6. So some countries had zeros like Germany, Poland, or but Finland, but some countries had more. And so the UK, yeah, there was this maintained one. Greece had a lot of as well, and this would be by time. Some would be before the European sovereign crisis, and some would be after. So yeah, so what is interesting is that, before the European sovereign crisis, Greece had a lot of reservation, so reporting on the accounts, and the UK had this maintained one. So here, yeah, the public sector creative accounting and the credit rating agency. So this is how it, SFA, I don't need unit for that. We don't need to look into that. But yes, this is like our advantage is it's one supranational entity. And the problem is that there is not much variation in the member states' governance indicators. And so what we looked was like the determinants first. So accounting, economic governance, and what we saw was really the stock flow was important, public deficit and GDP growth as well. And the governance didn't load, but it's still the AU, so it's very much same. I mean, not much variety in terms of governance indicators. And the ownership, we did see that the increased ownership before receiving a reservation. So that's very interesting. The increase in ownership there, and especially by the domestic central bank, just as if they would know they might be in a bit more difficult situation, they would ask their domestic central bank to help, even in countries like the EU. So and then when we looked at the ratings, then we did see no effect. We looked a lot. We have no effect when they are, reservation, even when they're expressed or maintained or withdrawn. We did see the majority of the effect after on the yields part being from the expressed one. So when they are issued for the first time. So this is how we computed the market impact. We did the cumulative abnormal return. So I don't think I need to go into much detail here, but we compared what would be the normal yield change relatively to the abnormal one. And so after we did see that, right after the reservation, we had an increase in yield here from 0.1%, and it was mostly coming from expressed reservation, and there was little effect or no statistically significant effect on the maintained and the withdrawn ones. So this is the main finding, I think, of our paper, is that they do have an effect, even on the yields. So that's, and we do see that it's it has a lasting effect with when there is a reservation, when there is no reservation. So that sovereign accounting quality does matter, even in a part of the world where it's kind of controlled, and it's perhaps, when we talk to people, really the best quality you can get is in the AU because of all the rules that have been implemented. So even though the debt is really high and worrisome, the debt, the accounting quality and transparency is high. So, and it does matter. So we had a very small sample of 67 observations, but we could find still some results. And the results will be more when it's relevant for the deficit or debt, when it's quantified, and when it's an initial release. And not disclosed. Yeah, when the years concern. Yes, when the years concern, no, all years concern matter. When it was perhaps yeah, and it was both pre and post matter, but in terms of significance, it mattered more after the European sovereign crisis, and it mattered more for countries like Greece, Italy, Portugal, Spain, and Ireland, like the problem, the one that suffered during the European sovereign crisis the most. And so, and after the reservation, we also saw a change, a more sovereign more domestic holding after reservation, just after reservation, more domestic holding. So that was an interesting finding from our paper. We are thinking about adding something related to ownership in our later paper, but the data set is very complex. So, and it's not that widely used. So this is, yeah, of domestic non-banks. So really the non-banks, we saw a raise in the domestic sector after reservation. So that's in a nutshell, really the paper that that we first started really on a bit of a clean context with just the European Union, and now we aimed to do something more widely interesting, I guess, or more with a wider coverage. That would be the one with the sovereign debt levels. So do you have any, is there any question on the, and
Yeah,
so it indeed worked, you know,
Yeah.
it indeed was then published after a few years.
Yeah, we do have a question on the chat. Is it possible, do you think, and there's a disagreement, right, regarding the dispersion, I mean the GDP dispersion, I think um by all of the rating agencies. Do you think could it become like a credibility crisis for certain countries, do you think?
Um, yeah, no, that's I think it does it is clearly related, indeed, the dispersion and the credibility on your numbers. So yes, it could, and I think that's what we learned also from the Greek example. You know, it's not so much, it's just indeed you suffer from the credibility of your numbers. So I think from the GDP, there is number, I mean, I think the credibility crisis would come from the debt rather than more the GDP one. And we did see that, you know, because for GDP there is a much wider agreement. You know, I do have somewhere, I think, the stat desk that I didn't show, but you know, the GDP assessment dispersion is like 0.03% of GDP. So it's a very low, there is much more agreement on the GDP number than on the debt number. You know, 3.3% of GDP versus 0.03. So it would come from a debt perspective, but we have seen a few countries really suffering. For example, you know, the Zimbabwe with the tuna bonds scandal, on the knowing, you know, what kind of you know, Malaysia, I think, also had a very big scandal recently on financial sovereign debt. So there is a credibility crisis possible in terms of debts, and that's why the IMF, you know, really advocates for more transparency on this issue and has now multiple frameworks to help the countries, because afterwards you kind of can lose the trust from investors.
Okay, all right. It's yeah, half past four already. I think it's been 90 minutes. I know there remains some question on the chat. Yeah, but I think we come to the end. Yeah. So again, thank you so much, Marian, for sharing your insights on this topic. I think most of the participants chat me privately. This is really new topics and not many literature out there, and especially in emerging countries, in countries like
Yes.
Indonesia, developing economies. This is really perhaps an interesting area to explore to explore on. But then again, we have a problem of literature, data. Yeah, I think maybe I mean anyone, if you probably have a question, if you probably wants to inquire more about this topic, I believe Dr. Marion will be more than welcome to be contacted by email, I believe.
Yes, of course.
Mm.
Yes, please do. Yeah, I will, be in the area for a while, I believe. So, so please, yeah, do contact me if, there is a specific interest in this literature for you.
Yeah, okay. All right. I think once again, everyone, let's give an online upload to Dr. Marian for sharing her insight, and to all the participants. Thank you also for your attendance, for your participation in this guest lecture. We hope that it broadens our perspective on the sovereign accounting practices and inspire us to do more research on this area. This is the end of our guest lecture today. Thank you so much, everyone. Good afternoon. Have a wonderful day ahead. And goodbye. Thank you again, Marian.
Thank you. Thank you so much to all. Have a great rest of your day as well.
Thank you very
Feel free to
much.
contact us.
Yeah, thank you.
You're welcome.
Thank you very much, Marianne.
Okay, so stop share.
Thank you, Milan.